I would recommend buying. I am not a fan of bond funds. I think bond fund is a second step. We buy bonds for our clients because we're familiar with bonds, and the clients have decided to give us their money and let us manage it. However, if that's not the case, and certainly not everybody wants their money managed. They like to do it themselves, or they're more comfortable, or whatever the reason is. In that case, I would say go to Vanguard, or maybe not Dimensional, but go to Vanguard and look for a bond ETF or a bond fund. And they will, and within that fund, they buy bonds. So a bond fund is simply the money pooled together in a mutual fund, but instead of buying stocks, they're buying bonds. And you could buy a corporate bond fund, a municipal bond fund, a 5 years and shorter bond fund, a 10 years and longer. There are all sorts of different flavors of bond funds out there, like there are stock funds. But my second choice, or for somebody that prefers to work on their own, first choice, absolutely. Look to a group like Vanguard and look at the ETFs and the funds that they offer. They're a great group. Yes?
What is an ETF?
An exchange-traded fund. ETF is exchange-traded fund. It's a fancy, you remember the old days when they had closed-ended funds? It's almost identical to a closed-end fund. And it is an even cheaper way for the public to access a very broad spectrum of whatever it is, stocks, bonds, commodities. There are a number of ETFs. There's an ETF out there that is solar power or something. I think the acronym is SUN maybe. You can buy broad-based ETFs. You can buy very narrowly focused ETFs. But they are an even cheaper alternative to the mutual fund, and becoming quickly as or more popular, I think, than the mutual funds.
Another question.
Yep.
And also, to me, I don't understand. I know that you can buy and sell bonds. If you get into a bond fund and you're into, let's say, a short-term municipal bond or whatever fund, why do they lose money then? If you give them money and you buy a bond, they're going to guarantee a certain rate for a certain amount of time.
Yes.
They buy a number of bonds. It's in this bond fund. Why should that bond fund over the course of it?
Why does it fluctuate in value?
No. Why can you lose money with a bond fund?
You can lose money because it fluctuates in value. So the second question is, well, why would a bond fluctuate in value? It's pretty set. It's going to come due in 3 years. It's going to pay me 6% per year for 3 years. Well, let's say interest rates are 4%. Somebody issues some bonds at 4%. You buy some. A couple days goes by, interest rates go to 6%. What's your 4% bond worth now that everyone's got 6% bonds? If I'm a buyer, I'm going to say, well, why would I want to buy your bond at 4 when I can buy 6? And so they say to you, and this gets a little confusing, I'll buy your bond at 6%, or I'll buy the new bond at 6%. But either way, 6%'s out there, that's what I'm going to buy. Sort of like going to Home Depot and saying, you know, I got it here at Lowe's and here at Home Depot. It's $30 cheaper at Lowe's. Why am I going to pay more at Home Depot? The same with the bonds. Why would I buy a 4% yield if I can buy a 6% yield? Well, I won't. I'm not going to pay you 100 cents on the dollar for that. I'm going to pay you 90 cents. And when I pay 90 cents on the dollar, it comes due worth 100. I've made a little bit of money there. Plus, I've gotten that 4% coupon. I've netted myself about 6%. That's why bonds fluctuate in value.
My question's still the same. Okay, 4%, still 4%,
Unless you sell the bond, yes.
So if you're into the bond fund, why are they selling it? Taking a loss on it.
Why do they sell them and take a loss?
It's still saying, I don't understand how a bond fund can lose money unless they sell it. How do you just hold it?
Well, because they're always getting priced.
Yeah, they're always priced on the open market.
Yeah.
So even if they didn't sell it, the value of the whole portfolio could be worth less even though they didn't sell it. So you're getting the price, you know, maybe the price fluctuated 2% that day because the overall value of those bonds fell in the portfolio. So, you know, you would lose money if you sold out on that day.
Yeah.
Okay.
If-
A home changes in value. If it goes from worth $250 to $150, it's worth $150 regardless of whether you sell it or not. Now, the owner may say, it's not worth $150, it's worth $250. But, you
We're all
know what I
saying
mean.
that right
Yeah,
now, right?
yeah, we're all saying that. Okay, I'll quit